We are looking at FAC1502. We're looking at the May-June 2015 paper. It's a 2-hour paper out of 100 marks. Good exam technique. Have a look at the proposed timetable and start with the question that you feel most comfortable with. We've got a general ledger accounts question looking at adjustments. We've got PPE note and statement of financial position asset section. We've got a bank recon, and we've got income and expenditure for a club. This would definitely be the most easy question to start with, the bank reconciliation. It's 25 marks, it's for 30 minutes. I'm going to start with question 3 just to show you how easy it is to pass that question or even to do well. And then you also save time, so you have more time to do one of the more difficult questions. So start with question 3. Let's have a look at it. There's question 3, 25 marks, 30 minutes. Most important is the required. What do they want? They want the bank columns for the cash receipts and cash payments, and they want you to properly balance bank account in the general ledger and the bank reconciliation statement. So they want all 3 of the actual required in terms of what we could potentially be asked for in this particular question. So let's go to our answer sheet and let's create a solution for it. Question 3. Part A was the receipts and payments journals. And cash payments. Day, details, and bank. They also want the general ledger, so that's B. Bank T accounts. Then we have the bank reconciliation statement. Debit and credit. And that's C. Okay, so now we're ready to actually look at the question and get all our marks for the bank recon. Let's go have a look at the first bits. Point number 1, bank recon as at 31st March 2015. Obviously, we're doing a bank reconciliation for 30th of April 2015. 30 April 2015. Here we've got March. So March would have been last month's bank recon. We need to confirm if all of these amounts have gone through. We need to check the credit, the outstanding credit. We need to check the payments that haven't gone through in the past, and we need to check if they've gone through this particular month. Most important here is opening balance. Debit balance as per the bank account. Balance at the end of March would be the opening for April. So I need that. 2650 is going to be my balance in my bank T account. Balance brought down. We need to check all these other accounts, and we're going to have to read the information to find out if last month's reconciling items have actually gone through. Number 2, totals in the bank columns of the cash journals. So I need that for my journals. Those are easy marks. In the receipts you had 30090, and in the payments you had 20054. That's the total in the receipts, that's the total in the payments. Then they say at 30 April the bank statement showed a favorable balance. That's the bank statement. Bank statement balance goes to the bank recon, 12,900. I can't change that bank balance. It's favorable, so it's going to be a credit balance. Then you've got the following items appear only on the April bank statement. So appearing on the bank statement, not in my books, I'm probably going to have to adjust. Checkbook, cash handling fees, those are all bank charges. So checkbook, cash handling fee, and the amounts. The checkbook had an amount of 96, the cash handling fee was 30. Then we've got interest on the credit balance, which is favorable, 50 Rand. That will go to my cash receipts. A stop order representing a payment on the mortgage. Stop order, that means it comes off your account. 2,000 would be for the mortgage. Stop order in favor of US Bank for installment on a motor vehicle. That's a motor vehicle installment. It's a payment. Yes, we've looked at all of those. 5. The outstanding deposit on 31st March was credited by the bank. So that means this figure over here can be ticked because the bank has now processed it. Number 6 says, checks that did not appear on the bank statement. We've got dated 20th of the 4th, 2015, so that's April. April, these are all outstanding checks. These are checks that have not been presented for payment yet. They will go to the bank recon. Okay, check number 211, 216, and 221. 211, 35, 32, 216, 36, 68, and 221 is 1,200. 1,200, great. 7. Check number 90 was issued in favor of Red Cross on 17 October 2014 as a donation. On 30 April 2015, it was decided to cancel the check and replace it with check number 221. No entries have been made for the cancellation of the check. So if I cancel a check, the check would have been paid and they would have gone through the cash payments. Now they want us to cancel the check, and this was check number 90. So there's check number 90 for 1,200 for a donation. That check needs to be cancelled. That's a stale check. Stale checks always go to the cash receipts. Number 8. Of the checks outstanding 31st March, only check number 170 was presented for payment. So only check number 170, and this was for last month. This was 31st of March. So 170 was presented for payment, so that one I can tick. This one, 168, hasn't been presented for payment, so it's outstanding last month. It'll still be outstanding this month. $168 was for 860. Check number 195 in favor of Handy Accreditor was correctly issued for 1578. However, on the counterfoil, it was recorded as 1758 and recorded in the cash payments journal as such. So that means your cash payments are too high. You need to reduce your cash payments because that's the correct answer. So you process 17 when you should have processed 15. So that means your cash payments are too high. If your cash payments are too high, you're going to decrease your payments by processing a receipt. The correction of the error is going to be for the difference, which is 180. An unpaid check for 500 appeared on the bank statement only. The check was received from S in settlement of his account of 5,000. 530, the check was marked RD. RD means dishonored check. Dishonored checks always go through to the cash payments, and that was an unpaid check of 500. Okay, this was to settle his account of 530, so there was a discount. Remember, discount isn't a cash line item. The discount would have been reversed out in the general journal. It wouldn't have affected your bank recon, so we're not going to consider the discount. That will be reversed out separately. 11. A deposit by debtor Y for 45 appeared in the bank statement. On investigation, it was found that the account of YY had previously been written off as irrecoverable. So that's a credit loss that you've recovered. That is going to now go to your cash receipts journal. Bad debts recovered, credit losses recovered. $4,500. Great, we've got two more. An unpaid check for 570 was received from a debtor, dated 24 May in payment of his account. The check was recorded in the cash records. The check was recorded in the cash records when it was received in April. The bank returned the check on 31st April, marked it as post-dated. So a post-dated check would be similar to a bank dishonored check. The reason for that is the check didn't get processed because it's post-dated, meaning it's dated for a future period. So that's going to go to your cash payments, similar to a dishonored check. It didn't go through, so you're going to have to process it here. Deposit of 987 made on the 31st has not been credited for the bank, so that means it's outstanding credit. Bank recon. Outstanding deposits. And the outstanding deposit was for an amount of 9870. Great, so now you've completed all those line items in terms of what was described in the receipts and payments journal as well as the bank recon. All you now need to do is total up. So if I sum up this side, I get that. If I sum up this side, I get that. Those totals are important. That total is going to increase the bank. CRJ. And I'm going to show that total. Then you've obviously got cash payments. CPJ. And in the cash payments, you're going to have that amount. So now I can balance this account. Looking at this account, the debit side looks bigger than the credit. If I add up those two amounts, I'm going to get that total. I want the same total on both sides. That's going to give me balance carried down and balance brought down. First of May. And I'm going to bring down that balance, which is the difference between those two amounts. 13,510. The last bit is to check if your bank recon balances as well. So I need to draw a total column there. I can see this side looks bigger than that side. So if I sum up the credits, I want to see that total on both sides. The balancing figure is going to be the balance as per the general ledger accounts, the bank general ledger accounts, and that will be equal to my total here, subtract all of those debits. And if that happens, where you get that balance coinciding with that balance, you know you've done the question correctly and you've got full marks. And that's question number 3. Now we're going to go back to the question paper, and we're going to go back to the proposed timetable. So I've done question 3. I'm now looking for another easy question. Looking at this, 25, 24, 26, they're all around about the same amount of marks, so no question here is going to be a bit easier than the other. They're all around about the same marks in terms of the percentage weighting, and they would all be relatively challenging but doable, because they're all equal in terms of mark allocation and time. So I'm just going to start with question 1 and go through the rest, and then I'll look at 2, and then I'll look at 4. Question 1 is looking at general ledger. That shouldn't be too bad because that's applying your debits and credits to the different tier accounts. So let's have a look at question 1. Here's the question, 25 marks, 30 minutes. Important is to look at the required. The required is asking for general ledger accounts, closed off or lazy. This was for the 28th of Feb. All calculations must be shown, and you've got long-term loan, accrued expenses, prepaid, inventory, and so on. So I'm going to have to draw up a tier account for all of these. Okay, how many do we have? Long-term loan, accrued expenses, 1, 2, 3, 4, 5, 6. Long-term loan and accrued expenses. Accrued expenses, prepaid expenses, inventory. Interest on long-term loan, insurance. And that's it. You've got all 6 accounts. You're now going to have to use the information in the question and post that through to the general ledger. And you're going to be looking at all of these accounts. They're all around about 3 marks, 4 marks, and then the longer ones here would be 5.5, probably because of calculations. Make sure you show all calculations. So let's start with the easy marks. The following information pertains to the business, and you've got the 28th of Feb. What month am I looking at here, or year? I'm looking at 2015. This was 2014. So you've got opening balances here because 2014 is last year. We're looking at things closed off for 2015, which is this year. So all of this will be opening balances. Long-term loan, 62,000. Long-term loan, 62,000. So I'm going to have balance here. What is this? 1st of March. Balance brought down. The balance here was 62,000. Next, fixed deposit, don't need. Vehicles, don't need. Accumulated depreciation, don't need. Prepaid expenses, now we know this is for insurance. I do need 500. Balance in the prepaid. Prepaid expenses is an asset. Debtors, don't need, it's an asset. Creditors, don't need, it's a liability. Current portion of the long-term loan. That I do need because that relates to the loan. So you've got a long-term loan here and you've got a current portion of the long-term loan. They've split it. This was all at the beginning of 2014. That means 5,000 is going to be paid during the next financial year, and 62,000 is representing the long term. So that will be part of your short-term liabilities, the current portion of the long-term loan. That's in terms of disclosure. In terms of posting to the general ledger just shows the loan as the loan. So I'm going to have to add an extra 5,000 here because that's the opening balance. Even if you're going to be making a payment late during the year, it's still considered a total in terms of a liability. It doesn't matter when you pay it. It's just the disclosure that we're trying to make use of in terms of creating a difference between a long-term and a short-term liability to be more accurate in terms of disclosure. Right now, you're just going to group it as one because as it stands, you owe that at the beginning of the year. Accrued income, interest on fixed deposit. Now we know what that's for. Do we have that? I think so. Did we? No, we didn't. Okay, so we actually didn't need that. Inventory, 25,000. That I did need. So here in inventory, I'm going to record the opening balance. and the inventory balance was 25,000. Then we've got accrued expenses, interest on the long-term loan. So we had prepaid earlier, now we've got accrued expenses. The accrued expenses has an opening balance. It's a liability. And the liability was for 6281.25. 6281.25. 6281.25. Great. Right, so now you've recorded all the opening balances. That's easy marks in every test and exam, just for knowing what the accounts are. Now we need to provide for the additional information. The following transaction must still be taken into account, so that means they haven't. An annual amount of 5,000 on the long-term loan is payable on 1 June of every year until it is fully repaid. So that's what we're looking at here in terms of the actual loan and interest calculation. So 5,000 is the interest. I'm going to be looking at the different dates. Obviously the beginning of the year. Would have been 1st of March 2014. They said you pay on 1st of June every year, so 1 June 2014 is when you would have made a payment, and then at the end of the year, which is 28th of Feb 2015, that would have been the year end. So start and end, and what happens during the year. Okay, going back to the question, they said 5,000 was the amount that you pay. That's where I pay 5,000, and we know what the balance is currently, 67,000. So if I'm looking at the loan interest, did I have this 67,000 for the full year? No, I only had that loan for part of the year. Then I've got this particular amount, okay, after I've paid 5,000 for the rest of the year. So you're going to have, in terms of interest, 67,000 times 12.5% times March, April, May, 3 months, so 3 over 12. Gives you an answer. 2093.75. Then you pay off 5,000 of the loan, so then interest now changes to 62,000 times 12.5% times 9 over 12. Gives me 5,812. So if I'm looking at the total interest is going to equal that amount plus this amount, gives me 7,906 Rand 25. Okay, this is an amount of interest that we need to provide for. We know that the balance here was, where was the balance? The balance here was 67. We know we're going to be paying a portion during the year. When do we pay? On the 1st of June. We make a payment, so that's going to affect our bank. Cash payments journal. We're paying 5,000. And then we'll have a balance brought down and carried down for the next period. Balance carried down, balance brought down. And that would be a long-term account, T account. We're looking at the interest here, so I need to provide for the interest. Has this interest been paid? Well, the interest hasn't been paid, because if I'm looking at the actual question here, they say, oh well, let me read this point as well. The loan was initially entered onto the 1st of June. According to the terms of the loan, interest is payable on the 1st of June every year in arrears. Interest is calculated at 12.5% per annum. So both of these points are important in terms of calculating the interest. They said it's payable on the 1st of June every year. So if we did pay the loan, not loan, if we did pay the interest, it will then come off that account. If we didn't pay the loan, it will be seen as an accrued expense. And that is at the 1st of June of every year. So the loan was initially entered to on the 1st of June 2013. So that was long ago, before this actual current year, which is 2015. And now we need to provide for the amount of interest that's payable. Alright, so if I'm looking at the accrued interest, I'm looking at a balance here. Okay, that was the balance, and that was from last year, because accrued interest would have been the interest that you haven't paid yet on that particular loan, because we know the accrued expense. Let me just show you that. Where is it? There's the accrued expense. No, that's the accrued income. Here's the accrued expense. Okay, the accrued expense is interest on the long-term loan. So this is how much you would have paid, or not paid, but incurred last year. Okay, the last period. So that would have been the opening balance. If it's an accrual, the accrual gets closed off to that specific account. So there will be an opening adjusting journal entry on the 1st of March 2014, and that would have been for the interest on loan. That would have been a transfer from previous month's general journal, and the amount here was given as 6281.25. That's the amount that I have that was from last year. Okay, we know that this year total interest that's payable amounts to that 7906.25. So we know there's going to be a balance brought down for the next period, and we know there's going to be a balance carried down, and we already know what the balance is. It's this amount. That's the amount that you have in terms of the carried down and brought down balances. Right, the same thing will still apply here in terms of total columns, and then we're looking for missing figures. Right, we know that in terms of interest, the total interest here was 79. Okay, we know a portion here is the 5812, and we know there's a portion there that was probably paid. We're not too sure if it was paid or not. If it was paid, then you would have to show it separately, as per the interest on loan accounts. So we're going to show that as 28th of, this would have been for this period, so end of July, which would have been the date that this would have accrued. Okay, so 31st of July, that would be the interest on loan, general journal, and the interest that you would provide for would be that amount, the amount that was incurred up until that point in time. Right, assuming we did pay it, then there wouldn't be any accrual. Then we'll just process the rest, which is that interest from 1st of June to 28th of Feb. We worked it out there, and that also would have gone to the interest on loan accounts. And there's your accrued expense. All we need to do now is check if the left and the right hand sides add up. Add up the right, add up the left, they both add up. It should add up because we're processing the actual adjustments for that particular account. Next, number 3. Inventory on hand at 28th of Feb amounted to 20,500. The periodic system is in use. So if periodic is being used, we need to calculate cost of sales. They tell us what the 28th Feb 2015 balance is, and that would have been the end of this year, not the end of last year. So in the question, they gave you opening stock. Here, they're giving me closing stock. So if I go to inventory, I'm going to have to record the closing stock. Balance carried down, balance brought down. And I would record 20,500 here. That would have been the balance that I would have brought down and carried down. What else do we have in the question? Let's go back and check. That's the inventory, so I've ticked that. Then the last point is look at insurance premiums. Right, so all I need to now do in terms of balancing the inventory account is looking at how much did the actual business purchase during the year, because that would have affected inventory. Inventory would have gone up every time I bought new stock. So where would I find that? I would get that from creditors control. creditors control is going to be looking at the amount that you would have purchased on credit. Here, did they say if you bought on cash or credit? No, they didn't. They didn't say anything about all purchases were made on credit or all purchases were made for cash. The question needs to give you a cost of sales because that will be recorded in inventory, but they didn't. They just gave you the opening balances and the balance that was carried down and brought down. So that was the balance at the beginning, that's the balance at the end. You would obviously expect to see cost of sales here. That's the question mark. And then you'd obviously expect to see purchases here, because inventory is an asset that will go up. That's what you're expecting to see, but that wasn't given in the question. If you balance this off, you'll see that side is actually bigger than this side. Well, then that would have indicated that you wouldn't have purchased anything during the year, which I don't think is the case. If you look at the question, you'll see that inventory was out of 3 marks. So you're probably going to have to balance this account off quite simply without having to record any cost of sales if they didn't give it to you. What you could do is you could try work it out from your creditors if they gave you an opening and a closing balance. Here we only had the opening balance. We didn't have a closing balance for creditors, which is problematic. So looking at that, I'm going to assume then that in terms of purchases that none were made, and then we would have 25,000 here, 25,000 there, and the balancing figure would be for the cost of sales, indicating this minus that. Gives you 4,500. You could assume that there were cost of sales, but then that would have had to have been given to you, and then you would have been able to calculate the balancing figure would have been the purchases then, right? Depending on the scenario, right? But I'm going to leave inventory just as is based on information that we were given in the actual question. Number 4, insurance premiums are paid in advance on 30th of June of every year and cover the period from 1st July of the current year to 30th of June of the following year. The insurance premium paid on the 30th of June was 4,500. Right, so this is a prepayment. If we're looking at beginning and end of the year, obviously we've got that information from before. This is for the insurance. Okay, so in terms of the insurance, 1st of March is the beginning, 20th of February is the end. We know that on 30th of June 2014, 30 June 2014, you paid 4,500, and that 4,500 was for a period of 12 months. So that means you've got 4,500 divided by 12 equals 375 per month. That's the amount that you're paying. If I'm looking at June to Feb, that'll be July, August, September, October, November, December, January, February. That's 8 months. So 8 months here would be in the year, and then obviously 4 months would be outside the year. And these 4 months outside the year would be classified as a prepaid expense. A prepaid expense is an asset, so that would affect your T account for the prepaid expense. My opening balance was given the question as 500. You can obviously see there's a prepaid expense here of 4 months. How much is 4 months? Let's check. 4 times 375 gives you 1,500 as a prepayment. If it's prepaid, it's going to be recorded on the debit side of your prepaid expenses. So you're going to increase your prepaid expenses because of prepaid insurance. They would have come from the insurance account. So it would be a general transaction, and they would have been 1,500 based on what we just spoke about on the right here, which was the working. Then we need to look at the balance. Obviously this side is bigger. Oh, we also had a balance though. I need to also discuss that, just to share with you something as well, before we actually balance the account. Remember, previous months accrual would come out of this month, because if something was prepaid last year, it's now going to be an expense this year. So we need to reverse out last year's adjustment. That would have taken place at the beginning of the year. Not balance, insurance. General journal. You would have closed off last year's prepayment to this year after having started the new entity, the new books. Right now we can sum up and we can see that this side is bigger than that side, and you'll have a balance carried down, balance brought down of 1,500. Balance carried down, balance brought down. And it would then be the difference being the 1,500, and that's your prepaid expense. So now we've looked at long-term loan, accrued expenses, prepaid, and inventory. We've just got two more to do. Okay, we've got the interest on the long-term loan, which we actually spoke about earlier. Remember, we had accruals here. I need to go back and show that. There's interest on long-term loan. Okay, so I should have actually recorded this as part of the interest on loan account as well. I'm going to show it now. If the credits are there, then you're going to have debits on this side. Equals that and that. We also had an accrued expense from last year. Last year's accrued expense was the balance for the accrued expense. Okay, so if that's the balance of your accrued expense that was from last year, this year you're going to have to process it. So you would close off the accrued expense by debiting it. So that's the debit. And then we'd obviously have to show that here as the processing of that particular expense. Okay, you could have done this earlier if you wanted to. I didn't look at the interest. We did the calculation, we didn't do the recording. So that would have been for 2015, and this would have been your accrued expenses opening balance. Right, that's the credit, and that credit's referencing this debit. Perfect. We know that in terms of the interest for the year, we calculated that. That's the total interest. This would be the expense for the year. 7,906. So if that's the expense for the year, you're going to close it off to profit and loss. Profit and loss would have had a debit, so this account would have had the credit because you're closing off this account, and that would have taken place at the end of the year. See, the date here is wrong. That was opening year, not closing, so 40, not 15. Okay, and the profit and loss figure that you would reference in your statement of comprehensive income would be that amount, 7,906 Rand 25. Then you've got the accrued expense, which is fine. You've got the interest, and you've got the interest that was provided for in terms of the accrual. The last bit would just be to work out the balancing figure, which would be for bank. Bank would have been on this side because you would have paid the interest on loan. That would have been the balancing figure. Okay, this is like incomplete records. Right, so it's going to be the total, subtract that, gives you a balance. We'll have a balance carried, no carried down and brought down, just need to add up. Sum up all of this. And I want that amount on both sides, and I'll be left with 6,281 Rand 25, which was actually paid by the business for interest on the long-term loan. Last bit is the insurance. In the question, they didn't give you anything relating to the insurance other than the prepaid expense. That would have been last year's prepayment. So last year's prepayment would be this year's expense. So the first step is to obviously process last year's prepayment to this year, so 500. So you would have to credit the prepayment from last year, and then you would have to debit this account with prepaid insurance. general journal, and that would have been for last month's adjustment. Where's the prepaid insurance? There's the prepaid insurance, 500. Maybe just to highlight that, just to show you what I'm looking at. Prepaid insurance here, that was for the prepaid insurance. So debit the one, credit the other. We also know that there's prepaid insurance this year, 1,500. So that would have gone through here, 1,500. Oh, too many zeros. 1,500. And that would have been from the prepaid insurance on the first day of the year. Not 14, 15. Okay, prepaid insurance. Okay, what else happened to insurance? Well, there would have been a profit or loss figure. We need to go back to the accruals. Let's see if there was anything given there. Prepaid insurance. No, there wasn't. Okay, we know that that was the insurance. So we're going to have to go back to the question and see, did they talk about the insurance premium? Yeah, they did. They said the insurance premium paid on the 30th of June 2014 was that. Okay, so you paid that in June. So that would have been 30th of June 2014. Bank, CPJ, and they said you paid 4,500. Your job is just to balance off this account, because that'll be closed off to your to your financial statements. Okay, so that side's bigger. So the net amount would be this minus that. Gives me 3,500, which would have been the 28th of the 2nd, 2015 profit or loss, profit or loss for this particular financial year. And that's the insurance. That's what you would disclose in your accounting records for all the different tier accounts. Great, now we've completed question number 1. Let's go back to the question paper. We're now going to be looking at the proposed timetable again, and we're going to be choosing another question. I'm going to be looking at the property, plant and equipment question for 24 marks at 29 minutes. You're looking at the note to PPE, and you're looking at the disclosure for the statement of financial position. So let's have a look at question 2. Here's question 2. They gave you an extract of the pre-adjustment trial balance. They've given you land and buildings, vehicles, equipment. They've given you accumulated depreciation, fixed deposit, trading inventory, debtors, and bank. They've given you some adjustments here, and they say prepare the property, plant and equipment notes in the annual financial statements of Tiger, and you need to prepare the asset section in the statement of financial position of Tiger Stores at 31st of March. Your answer must comply with IFRS. All calculations must be shown. The total column of PPE note can be omitted, so you don't need the actual total column for property, plant, and equipment. First things first is always to draw up your templates. So I'm going to have a PPE note, and the PPE note is going to have different columns. Important though is it'll be carrying value or balance. This would have been for the beginning of the year. In terms of beginning and end of the year, what are we looking at? 31st of March. So March then would have been April. So 1st of April would have been the start of the year. So we would have had balance here 1st of April 2014. Then we would have had cost and accumulated depreciation. Then we would have the same thing here at the bottom. After your additions, depreciation, and disposals. Disposals at carrying value. Great, and then we're going to have different columns. And those totals would be important. They also wanted the asset section of the statement of financial position. So that means we need to draw up an extract. We're going to have assets, which are broken up into non-current and current. Okay, now we need to go and get all our easy marks. Every past paper will always have easy marks. We just need to find those marks. So if I look at the question, they give us land and buildings at cost. This is for 31st of March 2015. This is for 31st March 2015. So ideally you would assume that this was for the end of year, but notice it's pre-adjustment. Pre-adjustment means before we've adjusted for those line items. So land and buildings at cost, 750,000. Let's record that. So I'm going to have these different columns representing all these different assets and liabilities. Well, not assets and liabilities, assets only because it's PPE. So you'll have land and buildings. And land and buildings started out at a cost of 750,000. Then they gave us vehicles 1st of April 2014. So because it's 1st April 2014, we know this is the opening balance, 275,000. This is for vehicles. Vehicles, cost price, 275,000. Next, equipment, 31st of March. So if we've got 31st of March, that means this is the closing balance of 600,000 for equipment. Then we've got accumulated depreciation vehicles 1st of April, and we've got accumulated depreciation equipment 1st of April. So these are both opening balances, 110 and 40. Then we've got a fixed deposit. A fixed deposit is a non-current asset. That's going to go through to your statement of financial position. So let's get to the statement of financial position. And we also need to record it at 60,000. Great, what else do we have? Trading inventory 1st of April. If that's 1st of April, that's opening stock. Remember, we don't show opening stock on the statement of financial position. We only show the closing stock. So I wouldn't require that because that's opening stock. I would require closing stock though. So I can obviously see, there we go. There's the closing stock. Okay, 26,000. So if you want to record it now, we can. You would show inventory here, and you would show it at 26,000. Okay, that's not going to change. Closing stock is what I show on the face of the statement of financial position. Okay, debtors, current asset, 42,000. 42,500. What else do I have? Bank, 72,600. Again, an asset here. Great, and those are all your easy marks. Make sure you get them, just for knowing what these balances are and recording them correctly. Now we need to look at the additional information. Number 1 says Tiger owned 2 vehicles on 31st of March. The original vehicle was bought on 1st April. As soon as I see more than one date in a question, that tells me I need to draw up a timeline. Right, so I need opening and closing stock. Not stock, opening and closing dates, right, for my vehicles. So I know the opening date was 1st of April. And I know the closing date was 31st of March. Okay, this is obviously for 2014. 2014, 2015. Okay, then they said in the question, Tiger Stores owned 2 vehicles on 31st March. So 2 vehicles on 31st March. The original vehicle was bought on the 1st of April 2012. Okay, so 1st April 2012. 1st April 2012, that was the original vehicle. Buy one. We bought one vehicle there. An additional vehicle was bought on the 31st of August, so 31st of August 2014. That was when we bought a new vehicle, buy. And we bought a vehicle that was worth 125,000. Okay, that's the purchasing of a new vehicle there. Depreciation on vehicles is provided for at 20% per annum on the straight line method and amounted to 69583 for the year. Okay, so that's great. They've already given you the depreciation for the year. Start and end. We want to know what the depreciation is during the year, which they've given it to you. Uh, 6969583 given in the actual question. So if that's given in the question, we can then record that in our accounting records for that particular date. So we know vehicles, where is it? Vehicles there, depreciation, negative 69583. We also know that we bought, so additions, we bought vehicles during the year. That was 125,000. Okay, they told us that we started with 275. So that means if we bought another vehicle there, in terms of cost at the end, would have been cost at the beginning plus additions, gave you the 400,000 at the end. In terms of depreciation, that's the depreciation I started with, that's the depreciation during. If I add those two amounts together, I'm going to get the depreciation at the end. Great, now we've got equipment and we've got land and buildings to still provide for. We've looked at point number 1. Point number 2 says depreciation on equipment must still be provided for at 10% per annum on the diminishing balance method. Okay, diminishing balance. So that requires a timeline again. They said all equipment in use was bought on the 31st of December 2013. Some of the equipment was sold. Okay, so there's an asset disposal. So I'm going to need those dates. Start and end. This is for vehicles. This is for equipment. Okay, and for the equipment, I'm obviously starting here. The date that they said bought on 30th of September 2013. So 2013. And 2014. There's 2014. So there's 2014, and then you would have had 2013 as well. Great. So this was, some of the equipment was sold for that on there. So proceeds, 170,000 there. And this is using diminishing balance. The cost price of the equipment that was sold amounted to 200,000. Cost here was 200,000. That's what we know for sure from the question. Great. What else do we know? Well, they said in the question that we bought all the equipment here. Then we sold a portion there. And then we've obviously got some left over. So we need some more information from the actual question. Equipment 31st March 2015. That would have been end of the year, 600,000. So that means we've got cost here at the end, 600,000. That is the cost at the end. They told us we sold some during. So that means if I sold some during, I would have started with 800,000. That's how much I would have started with in terms of costs. So I ended with 600. I sold 200 during the year, so I must have started with 800,000. Okay, we're looking at the proceeds from the sale of the old assets. So we need to know what is the carrying value for the assets sold. Okay, that's basically what we're trying to find. So we know that it was sold, well, the cost was 200,000. That would have been here. Cost of 200,000 at 30th of September 2013. So 30 September 2013 to 1st of April would have been September. We wouldn't count September, so we would count October, November, December, January, February, March. That's 6 months. So depreciation from here to there $200,000 times 10% times 6/12 gives you an amount of equals 1,000. Okay, and then we still have more depreciation from that point in time to that point in time. So then depreciation here would have been the carrying value, 200,000 less 10,000, close brackets, times 10% times. Okay, so April to September. April, May, June, July, August, September. Another 6 months. 6/12. And that gives me $9,500. Great, so now I know that in terms of accumulated depreciation, total accumulated depreciation at date of sale is 10 plus 9, 19,500. 19,500 is the total at that point in time. Right, so now we know that at that point in time, you've got total depreciation of that, so the carrying value is cost minus accumulated depreciation. So cost is 200, less accumulated depreciation gives you that carrying value. So now I know what the carrying value is of the asset that I've sold, and that is what I would disclose in my where's it? Here's it. Where's the equipment? This was equipment. Yeah, it was equipment. Disposals. So disposals will equal that figure over there, the carrying value. Okay, depreciation is what you've used during the year. There were no additions. We just need to work out the amount that I've used during the year. So currently we know how much depreciation we had for the year. That was the 9,500. And we're also going to have to add this 80,000. So what's left over would have been 600,000. That would have been what's left over. Okay, so in other words, existing cost, accumulated depreciation. The cost would have been the 8 minus the 2. That would have been what you still have. Okay, and what I still have would have been depreciated for the full year. They told me what accumulated depreciation was at the beginning of the year. Here's it, 40,000. Okay, that was at the beginning of the year. But the 40,000 includes this 10,000 here for the asset that you sold. So 40,000 minus the 10,000 for the asset that you've sold. That gives you 30,000. So carrying value here is 600 minus 30. Gives you that. Times that by 10% because you had it for the full year. And that gives you 57,000. So depreciation for the year would have been those two amounts added together. 57 plus 9,500. Depreciation, so this amount and that amount. Great, so now all we need to do is just sum and total up. We've got costs, which we said was 800,000, minus the accumulated. Okay, so let's just go back and have a look. Okay, the interest will provide and the credit loss will provide just now. Okay, so we just need to wrap up that 0 there. No. This will be 750. That'll be 750. 0 there. Okay, this would have been this minus that. Okay, then we've got the additions, and we've got, okay, then this minus that. Then for equipment, same thing would apply here. The difference there, no additions. There were disposals though, and then we've got the accumulated at the end of the year. The accumulated at the end of the year for this particular company would have been, well, the accumulated is what you started with, okay, and the depreciation is what you had during the year. So start plus what you had during the year, and then you would subtract the accumulated depreciation for the asset that you sold. So let's work that out. It'll be this plus the depreciation, and then subtract minus the depreciation you had for the old asset that you sold. So I sold the old asset, I would have taken this out, and I would have taken that out. So then you'd be left with that accumulated. Okay, because accumulated depreciation is what you had, which would have had everything in it. It would have had the 10,000 here, and then the depreciation is the 9,500, which we included there. But because we were selling the asset, we were taking it out of the accumulated. So then that would have been the balance that you would have had for that particular account. Okay, it's land and buildings. Right, they didn't ask for the total column, but if they did, then the only total that would be important would be this one. This plus that plus this, and that gives you that total. Right, that total would have gone through to your disclosure here. Non-current, so I would have property, plant and equipment, and I would show the balance. They would have been calculated from here. Okay, which would have been the land plus the vehicles plus the equipment gives you that total, and they would have come from the note. That's how you would disclose it. Okay, the last bit is looking at interest here. Interest of 10% per annum must still be provided for on the fixed deposit. The amount was invested with small bank. Okay, so it's still going to be provided for. So that would have been seen as an accrued income. You're still going to get it. Accrued interest income. Accrued interest income would have increased your current assets. Accrued interest income. In brackets, it was 60,000 times 10%. It was taken out on the 1st of April, so 1st April to March is a full year. So you would have 6,000 there. Okay, that's the accrued interest income. They would have affected your income positively, which isn't part of the statement of financial position. The interest would have been kept separate in the statement of comprehensive income. Okay, what's next? The credit losses. Credit losses will decrease your debtors, so minus 600 there. Okay, now you just need to wrap everything up. This stays at 60,000. So my non-current would have been this plus that. Gives me my total non-current. Okay, that's non-current. Then I've got current. Current would have been, okay, well, these totals, let's work out what that is. And 7,200. Well, bank would have been the proceeds. We can't forget about the proceeds from the sale. Okay, don't forget about the proceeds from the sale here. Proceeds of the sale would increase the bank. 170,000. And then we need to add up all our current assets. Sum up the current assets, gives me that. And then I would add up my non-current and current, and then I would have a line item here. For the total assets. The total assets would be my non-current plus my current. Great, and that completes this question. Right, now we need to go look at another question. We've got the final question to do. We've looked at question 1, 2, and 3. We now have question 4 left. Income and expenditure statement of a club. That's the last question to do. There's question 4. And we're looking at a club. Okay, you've got a golf club. They've given you balances at the beginning of the year, and they've also given you some additional information. Then they've given you prepare the statements, dining room trading statement, that's A, and then income and expenditure statement, that's B. So let's write that down. A is the dining room trading statement. So trading means they're buying and selling goods. And then B, statement of income and expenditure. Okay, that's what they've asked you to draw up. First bit, get your easy marks. Go down the list of accounts and identify what things are. Green fees and caddy fees received. That would be seen as income. Income and expenses, and then we'll obviously have a surplus or deficit for the year. Okay, so income, green fees and caddy fees, 16,000. Next, bank debit balance. They would have gone into the statement of financial position. I'm not going to need it for the statement of income and expenditure. Crockery and linen at cost. Crockery and linen at cost would be an expense that we would incur, and it would probably be used in the dining room, the crockery and linen at cost. So I would be looking at that as being cost of sales, as a cost of sale calculation for the crockery and linen at cost. That's a possibility. If not, it could be shown as a separate line item for your expenses, because that would be the amount that you would have utilized during the year. Crockery and linen at cost. So let's record that here. At cost. Debtors control, assets, creditors liability, telephone expenses. Okay, telephone expense is seen as an expense, so we would record that as the expense in the actual statement of income and expenditure, and the amount for the telephone was 6,600. Dining room, there we go. Now we've got information about the dining room, purchases, wages, sales, and then we've got inventory. So we're going to need these amounts in order to calculate the dining room trading profit. So we've got opening stock, we've got the sales here, we've got the wages, that's another expense, and then we've got the purchase, which would be part of the opening stock calculation. Right, so dining room sales amounted to 30,000. Okay, then we'd have a cost of sales calculation. Cost of sales would have been opening stock. Opening stock was 1,000. Okay, plus your purchases of 14,500. Okay, and then we still need the other, so returns and closing stock. Then we've got other expenses, which we read just now, which was the wages, and the wages was an amount of 10,000. And then we'll obviously have a gross profit here. From the dining room. And the gross profit from the dining room will be recorded as income. Dining room. Buildings, asset, land, asset, implements and tools, asset. Depreciation, negative asset. Well, accumulated depreciation, negative asset. Maintenance expenses, that's what I need. Maintenance expense. Maintenance was 10,900. What else do we have? Entrance fees received, that's an income. Then you've got gross profit bar and wages bar. So gross profit bar, wages bar. Okay, the wages for the bar was 12,000. You could offset these against each other because the one would affect the other. And the gross profit for the bar was 49,500. Then we've got membership fees. Membership fees, we know we'll always have a tier count for it. See workings. Okay, membership fees always has a tier count, so I'm going to draw a little sketch here. Membership fees. What else do we have? Furniture, asset. Accumulated depreciation, negative asset. Accumulated fund, equity. Interest expense, needed. Interest expense, 37500. Salaries and wages expense, stationery expense, mortgage liability, insurance prepaid. Insurance is expense, the prepaid is the asset. So you'd have salaries and wages. Salaries and wages 35,000. Stationery 2,000. Mortgage is liability. Insurance you'll have, but not the prepayment, the actual expense part of it. Okay, and that's it. Now we need to look at the adjustments. Bar inventory at 30th of December amounted to 2,500. Okay, so this is the bar inventory. This would have gone to the bar, the gross profit. It would have been part of the gross profit for the bar, which I think they gave it to us. Where is it? Bar, yeah, gross profit bar. There's it. So gross profit of the bar is already the gross profit, meaning we would have taken the bar inventory into account because we would have subtracted the closing stock when calculating the gross profit for the actual bar. At 31st of December, dining room inventory was not counted, but it can be assumed that the usual gross profit margin of 50% on turnover was realized. Okay, so we wouldn't count the stock, but we know that 50% turnover was provided for. So if my sales are 30,000, my cost of sales would have been 50% of it, half of it, so negative 15,000, and then your gross profit for the dining room would have been 15 minus the wages, which would have given you a net profit minus 10,000 here gives you 5,000 overall profit here. Okay, so 5,000 is the net profit from the dining room. So net profit from the dining room, 5,000 would go there. Then we've got crockery and linen valued at 5,000. See, there's that note about the crockery and linen 5,000. So obviously we would have to provide for the crockery and linen that we would be making use of, because crockery and linen would be something that the bar, the dining room would probably use. So that could be part of the opening or closing stock, or seen as like an expense. So I would be showing this as an expense, which is the amount that was actually used. Crockery and linen at cost, brackets used. So you had opening and closing stock, so the difference would have been what you've actually used. Where was the crockery and linen? There, crockery and linen cost, that's the opening stock, 7,000. How much did you have at the end? You had 5,000. So there was obviously 2,000 that was used. It could be damaged or broken or used up, but 2,000 would have been what I would record there for crockery and linen. Then they say implements and tools must be depreciated 20% per annum using the diminishing balance method. Right, that's implements and tools. So depreciation. Implements and tools. It's on diminishing balance. So I'm going to have to take the costs minus the accumulated depreciation. So if we look at the question, you have 21,000 minus 11,000. Close brackets times 20%. Okay, gives us an answer of 2,000. Next, furniture must be depreciated by 1,000. That's easy. £1,000. Insurance premiums paid during the year amounted to 1,600. Were debited to the telephone expense account. Okay, that's bad. That means that telephone actually has my insurance. I need to show it separate. Half of this account is to be regarded as insurance prepaid. Okay, we can see there that we had insurance prepaid, but that was from last year. So that was last year's prepayment. So that we need to obviously take into consideration this year. So let's go to the insurance account. There's the insurance account. I'm going to show 1,600 here. Okay, half of it was prepaid. So minus half of it, 1,600 divided by 2. And then you had last month's prepaid, which would have been a debit balance. To remove that, I would have credited and I would have debited. So I would have to add last month's expense that was prepaid. Right, so insurance will be an amount of 1,200. That would have been my insurance. And telephone, you have to subtract the amount that you took out, 1,600. So you took out 1,600 from telephone to show it separately as insurance. And then they said half of it was prepaid. The balance of the membership fees account was compiled from the following: an amount of 1,800 in respect of membership fees at 31st of December 2013. Okay, so that was 2013. That's prepaid membership fees. So prepaid membership fees is a income received in advance line item, and cash received during the year amounted to 82,200. The balance is still adjusted for membership fees and arrears, amounting to 1,000. Okay, that will be an accrued income, and then you've got income received in advance, which is the prepaid membership fees here, amounting to 2,100. So all of that information needs to be drawn up in a tier account. So we just spoke about the membership fees. We know that last year's membership fees that was prepaid, so prepaid membership fees was 1,800. Right, then we know we received a certain amount during the year, so bank went up by 8,200. Right, then we know there was accrued membership fees, arrears, okay, for this year, 31st of the 12th. 31st of the 12th. That would have been accrued membership fees income. Okay, and the accrued membership fees income would have been 1,000. Right, then they told us there was income received in advance or prepaid membership fees. That's the vocabulary they're using for this year. So this year's prepaid membership fees is an amount of 2,100. Right, looking at this this particular account, you can see that this side is bigger. So if I sum up all of my credits, I'm going to get 85,000. Okay, and the balancing figure is going to be my profit and loss. Balancing figure which would have gone through to your membership fees account. Okay, so that's why I do a T account, is to get that one answer. Okay, and then I would show that as part of your membership fees for that particular year. A new members register which is currently in use was designed to print for the club at a quoted price of 100. The transaction is still be to record in the accounting records. Okay, so still to be recorded. That would have been part of your, you could record it as stationery or as a separate balance for this, oh sorry, wrong one, new members register. Okay, it's designed and printed for the club at a quoted price. So new members register, I'm going to keep it separate. New register, it probably could be classified as stationery. I'm going to show it as separate 100 Rand. The club secretary went to leave before Christmas and was paid his January salary of 1,200 in advance. Okay, so that's a prepaid expense. A prepaid expense would reduce the salaries and wages because it's a prepayment, and that was 1,200, and that was part of the salaries and wages account. Okay, for the club secretary. Right, so minus 1,200 here as a prepayment. Great, what else do we have? On 29 December, a club member deposited an amount of 500 in the club's bank account as a donation. Right, so that would be a donation that was received, so donation fee income, or donation income, or received, and the donation was for an amount of 500. On the 29th of December, a club member deposited an amount of, okay, we read that one. The mortgage bears interest of 15% per annum and is secured by first mortgage over land and buildings. Okay, so we need to know what the mortgage is. The mortgage was 500,000. Okay, so 500,000 times 15%. Okay, which is what the interest is calculated at. What does that give me? 75,000. Yeah. Okay, so 75,000 is the interest on mortgage. Where's my interest on mortgage? Interest expense. Okay, there's it. So 500,000 times 15% is 75,000. Right, so you would 37,500 times 2, I think, is 75. Yes. So you'd have to double this, plus 375000. Okay, add another 37,500. The entrance fees must not be capitalized. So if it must not be capitalized, it will be part of income. So your entrance fees will stay as is. Okay, so now we've completed everything. We just need to look at the balancing figures. So net profit for the dining room we've worked out 5,000. 5,000 went here in the dining room. The green fees, caddies and green fees will stay at 16. Gross profit for the bar, which will keep at 49,500. Entrance fees received, that was 10,500. Then we've got the membership fees. We've got the net income from the dining room. We've got the donation income, so that's all fine. Total income, if I had to sum up all of this, gives me that answer. So that's representing the total income. Then we need to look at all the expenses. Telephone, we need to subtract there. So telephone here would be 5,000. Maintenance, that didn't change. Wages for the bar, that didn't change. Stationery didn't change. And then we've got all these other line items, the insurance and so on. So total expenses, sum up all of that, gives me that answer over there. Right, and now I'm just going to work out the balancing figure. Okay, the balancing figure would then be my income minus my expenses, and that gives me the surplus or deficit for the year. So this is looking quite good. This would be seen as a surplus for the year. And that covers another past paper. We've now looked at May-June 2015. I hope you're finding these past papers easier as you do more of them. Practice is important, so keep practicing and you'll be fine.